And talking about taxes now, differing views about whether we're headed for a recession, but would a tax cut help to keep our economy growing? Let's talk about it to our Fox panel. Scott Martin from AstorLLC.com, Toby Smith of ChangeWave Research, independent trader Eric Bolling, and Peter Schiff, author of Crash Proof. Quite a group we got here. Eric, let's start with you. If we're slowing, it's one of the few things that economists agree on. If you're going into a recession, you don't want a tax hike, because that's going to slow things down.
Well, yeah, look what happened since the 2000. You see my gold?
You never are without this gold. He lets me touch it and hold it and look at it.
I saw him. You see him grab that?
Oh,
anyway, look what's happened since the 2003 Bush tax cuts. Tax receipts have skyrocketed. They've outpaced the GDP growth by double, almost triple. So what does it tell you? It tells you that when you do cut taxes, whether it's corporate taxes, whether it's personal income taxes, you stimulate growth in the economy, and that's what's happened. And I think if you do feel like we're headed toward any sort of recession, it's not a bad idea to maybe cut some taxes and have the growth picture become more robust.
Peter Schiff, we got this producer price index number, and the simple way of explaining it is that as prices at the wholesale level and how much inflation we've seen, the number came in hot, up 3.2% for that headline number. The energy part of it, up 14.1%. You're not telling Americans anything they don't know about how much that they are paying at the pump. But if you have high inflation but weak growth, what do you do about tax hiking or cutting? What is your perspective?
Well, first of all, the burden on the economy is not necessarily what the government taxes, but what it spends. What we need to do is cut spending. If they simply cut taxes and print the difference, we get hit with the inflation tax. And that's why prices are rising, because the government is creating so much inflation. Somebody just mentioned that the value of the dollar determines our competitiveness. It determines our standard of living. And our standard of living is falling as the dollar is being debased.
Well, Toby Smith, I saw you shaking your head no when Peter Schiff was talking.
That was the 30-second Peter Schiff for debasing our dollar thing, and I always appreciate hearing that. But let's look at a couple things. First off, if you're going to look at income tax, or you look at all taxes, look at the taxes that are coming from non-withheld taxes. That's a big difference, because Eric's right. Not only are tax receipts up.
So look at the stuff other than you see on your paycheck every week.
That's actually up almost at a 20% rate. What does that tell you? It says people are investing, people are buying and selling stocks, etc., and those capital gains from buyouts, etc., have blossomed, number one. Number two, if you are heading into a recession, the last thing you want to be doing is cutting spending at the same time. The time you sort of juice the economy is when you have a slowdown, and what we've done is increase spending based on tax receipts coming in, get the war to go right for us a little bit, and cut the spending there. All of a sudden, we've got the fuel to get this economy back and going.
The reason we're in so much trouble is because we spent too much. We spent money we didn't have, and we borrowed it from the rest of the world.
Well, I mean, you can argue that later. Right now, we're in a soft part where, that's not the time to become moralistic about spending.
It's time for Liz to speak. Liz, go ahead.
Okay, I want to hear from Scott Martin. Scott, we've got a $1 trillion war here. We're going to talk about this with the Senator Mitch McConnell, too. We've got the $1 trillion war. We've seen tax cuts. How do we make up the difference, if not cutting spending, which we haven't seen come out of Washington?
We haven't, Liz, and we're talking about GDP slowing down again, which government spending is a big component of. So that's another area you have to look at. The government might try to subsidize that, too. I think, going into recession, the last thing you want, as you guys have said, is a tax hike. But the way we've got the election coming up, I mean, that's obviously going to take forefront. But what are you going to do when we have this slower growth, slower GDP? You're going to hear qualms for cutting spending, but you're also going to hear maybe some qualms for raising taxes. I mean, I think it puts everybody in a really tough position. And I'm just glad I'm not running. That's what I'm going to say.
Well, Eric, what happens to the first person that calls for a tax hike? Are they toast in the election? Because if it happens before November 2008, that's a risky thing to do. We've seen other politicians go down who did that.
Yeah, I wouldn't think that'd be very advisable going into the election. I think they'll probably skirt the issue a little bit. I'd like to address this GDP slowing that everyone's talking about. Today, with those retail sales numbers,
double what was expected.
Almost triple. If you take autos out, it was about triple. Both Morgan Stanley and Bank of America increased their fourth quarter GDP estimate by almost a full percentage point. So what does that tell you? as things evolve, as the fourth quarter evolves, as the first quarter of next year evolves, you may see this really kind of recessionary pointing GDP situation turn into something growth.
Lehman Brothers dropped their fourth quarter estimate. Lehman Brothers is calling for very weak growth.
Yeah, recession, exactly. You're hearing one for the other.
Yeah, but Liz, look at the deferred economics.
You got 5 seconds before
we have pushed a lot of our economics into the first and second quarter of next year.
And you did it. We're going to be talking about an energy bill right after this.
David, the Senate taking another shot at
It is time for our end of the day market panel, beginning with my buddy Tracy Burns, who is right down on the floor of the New York Stock Exchange. It looks a little quiet down there, Trace.
Yeah, David, I think it's because there's still this uncertainty. The market's skittish. It's volatile. Nobody knows what to do. You know, we started the day out with the producer price index basically reinforcing that inflation's an issue. And, you know, no one's happy to hear about that. Then we get numbers from Lehman Brothers, starting to hear from the financials. And while the numbers were good, the market really didn't believe it. You know, they said, we're going to write off $3.5 billion, and pretty much everybody said, yeah, that's not enough. So there's this tentativeness, this skittishness, and this lack of conviction to the point where they'd much rather sell than buy at this point. You know, sell when the market's up, take their profits and go home, as opposed to putting more money in and buying at this point, at this time of the year. Still, though, then we get retail numbers. Sales are pretty good, and as a result, the retail stocks were up today. You know, in the Fox 50, Nike, Best Buy, Walmart, all did really well. And, of course, with all this skittishness, there's no surprise that there's this flight to quality. So your defensive plays, like Pepsi, Coke, Budweiser, all did well today. So we're in this really unknown, little uncharted territory right now. Again, the down volume, meaning the sells, is much higher than the buys, and so that's what they're doing. You know, the market's up a little bit, they're taking their money, and then potentially calling it a day for the, you know, or calling it the end of the year, wrapping things up. We're going to see a lot more of this between now and the end of the year. David?
All right, Tracy, thanks very much. Let's throw it to our Fox panel, and beginning with my friend, Mr. Toby Smith. What do you think?
Well, look at. We're going to have more write-offs in the bank. I mean, we're not close to the bottom in terms of the writing off. The question is you know, we have a bottom when we do the really big unexpected write-off, and those stocks go up, and we're not quite there yet. I mean, as you know, full disclosure, we're short Citibank, we're short the NBI.
You say we're not quite there yet, and then you said we're far away from there. How close are we?
Certainly we're going to have to get to this fourth quarter. These guys start bringing the numbers out. Into the first quarter, we're going to continue to have that. Now, that said, growth stocks, companies that are real good old secular growth companies that sell all over the world, you know, we hit some 52-week highs on about 8 of our stocks today. So.
Well, you know, I still think the Wall Street is underestimating these problems. I mean, the problems for corporate profits, for the economy, are enormous. You know, just in the beginning of the year, you know, subprime mortgages were trading above par, which meant Wall Street thought there was no problem, even though there was plenty of evidence that there was a growing problem. All of a sudden...
Not a going problem? A going problem?
But all of a sudden, they connected the dots and they collapsed. And I think shortly, people are going to start to realize how bad the situation is, and stocks are going a lot lower.
I love it how Mike Norman screams at you, and Toby just makes fun of you.
My kid is fun. There's no screaming involved.
All right, Scott Martin, what do you think is going on with the market?
I think there's two things to watch going forward, guys. Number one, macro data, jobs first and foremost, but also the Fed. I mean, I don't know, guys, what has more performance-enhancing substance in it. Global credit markets, sorry, Eric, or Major League Baseball. I'm telling you guys, look, watch the Fed and see how the market reacts. The market hasn't really taken what the Fed has done so far as exactly good medicine. They didn't like the rate cut. They haven't liked the rate cut since they started. I think you got to watch out for that because, again, the more the Fed pumps in, the more the market wants more, and that's not exactly a good thing.
What about this new $40 billion window that the Fed announced yesterday?
Well, it's a beginning. It gets the thing going. Remember, the key issues we've talked about is the fact that the London Interbank Exchange, the LIBOR rate, is still so much higher than it normally is. Until that gets unstuck, you know, we still have problems. So what they said was, we're going to not use the window, which is bad. You're going to do an auction. That's good. Well, you know, this is still an experiment, guys. They're still in the dark.
And you see how that's going to go. You got to watch out 2 months to see how the subscription goes to that, because there's two phases
thanks very much. The closing bell just a few minutes away. We're going to be there with you.